All right, fools, you are here for the Millionacres Hour where we get to talk real estate, and we're going to do a little rapid fire returns today. Huh, Matt?
That's right. I think we've got 7 or 8 companies' earnings that we're going to be talking about.
I,
So,
I just love earnings season. I mean, I love listening to the calls. The whole process, I think, is really exciting. But I think one of the things that we're going to talk about today is sort of how you can use looking at this particular quarter to sort of give you a look at what the longer goals of the company are. And that's why it's really, I think for investors, it's like a check-in point. Like, I don't think that a lot of people make a decision to stay or go based on a single earnings season. And I'm not sure you should, but it should either contribute to or maybe take away from your investing thesis. What do you think?
I totally agree with that. I think that's exactly the right way to think about earnings. I think a lot of investors who have followed the market for years see a lot of volatility, around earnings. Stocks go up and down pretty sharply. We don't see so much of that in the real estate market, but for investors, and when investors, your default a long-term investor, right? That's what David Gardner always says. And so, yeah, I think they're just useful checkpoints. Now, if you have a thesis about a company, I do think quarterly earnings can tell you if something's changed or if there's a different direction the company's taking in the long run that could inform you about whether or not you want to keep holding the stock. But that's rare. I mean, I think generally every recommendation I know we make in Million Acres, we're looking to hold for at least 3 years, but preferably a lot longer. And so every quarter's earnings are just another, like you said, checkpoint into what's going on with the business, but almost always never a reason to take any action with the company at all.
Yeah, but sometimes there are a few surprises in there.
There always are a few surprises, and we'll probably talk about a few of them, I guess, throughout the course of the hour. All right, I will go ahead and let me share my screen, Deidre, and this is where I always sort of panic, of course, but all right. Tell me if you see that.
Yep, I see it.
Oh, good. All right. So this is the real estate investing hour with Million Acres. And of course, I like to think of it, Deidre, as the get rich slow hour in Fool Live, because I think so many of the conversations that, we see across Fool Live are talking about exciting companies like Square and Afterpay, which I know nothing about, but it sounds really exciting, and Square's buying them for some reason. But I do know a little stuff about real estate, and so let's get into it. I like to always talk about, as you know, Deidre, the taking a kind of a broader look at the market performance. And hey, it's been a fantastic year for stocks. I mean, these returns as of yesterday's market close, and the S&P 500 17.8%. I mean, that, and by any measure, that's a fantastic year. That's a fantastic 2 years most of the time. And of course, the NASDAQ 100 is just right there as well. But real estate is still king. Here we are. We're through 7 months. We have 5 months to go. I'm hoping that real estate keeps its crown, but it certainly has so far. It's as you can see, the Vanguard Real Estate ETF up over 26%, which is fantastic. But I have to say, I'm a little disappointed in this slide a little bit, because if I look at our real estate winners recommendation or our mogul recommendations, they're trailing the Vanguard Real Estate ETF by a little bit so far. Just a little bit, but still, enough where I'm a little irked by that. So hopefully some of our recommendations can kick it into higher gear for the rest of the year and catch the Vanguard Real Estate ETF, because it is my preferred benchmark, I guess, when it comes to real estate investing. And it's had a fantastic year. Unreal. And one of the things I think that's happening this year, and Deidre, you know, I've looked at this table that REIT put out a little while ago, which I think is so informative, because if I think about the years coming into 2021, now, of course, we had a historic pandemic. We have a historic pandemic, and that really affected returns in 2020. But even before that, real estate REITs were kind of underperforming the market. They've kind of had a relatively underperforming decade, actually going back to the last financial crisis. And one of the reasons I think that might be the case is because we had such low inflation over the past decade, up until recently. And so that, if you look at this and understand how REITs have performed in low inflationary markets, you can see that, it's not unusual for REITs to have underperformed. This year, of course, and sort of beginning late last year, we sort of began to see a real pickup in inflation in a lot of parts of the market. We know the economists have been talking about it. The Fed's been talking about it. Whether or not it's transitory, how much it's going to translate. It certainly doesn't seem transitory in the housing market, which we'll talk about in a bit. But there is a real inflation scare, I think, in the market, and that could actually be helping REITs, because if you look at how REITs have performed, during periods of moderate inflation or high inflation, REITs have been the preferred investment vehicles during those periods. So I just like to talk about that. But then let's also talk about one other factor that I think is helping REITs, which is balance sheets are in the best shape, Deidre, they've been in years. If you look at the interest expense as a percentage of net operating income, we are at the lowest point, going back to the early 2000s. And I dare I say, I don't know how far this data might go back, but I bet you it's probably multi-decade low, well back into the 90s and 80s in terms of that. And so you can see that not only are REITs benefiting from a lot of pricing pressures in the market, they're also benefiting from just having great balance sheets and being able to be nimble and take advantage of the opportunities in the market. So is that kind of what you've been reading about and seeing?
Yeah, and I think that's really important right now. One of the things that I was looking for in second quarter earnings was to hear about acquisitions. Ever since the pandemic started, we heard so much about dry powder on the sidelines, maybe distressed assets, all of that. So looking a little bit to see what companies are planning to do and really what they're seeing in commercial, because the pace has picked up, obviously, since last year. A lot of deals going down, but that flood of distressed properties never happened. Some of that dry powder is still just sitting there.
It is. And you go back to the first, second, and third quarter last year, you had a lot of REITs who they pulled back. They had acquisition plans for 2020. They cut those back big time. They cut dividends or paused their dividend. And so by the impact, the severe impact of COVID, REITs really just really batten down the hatches, and just slowly they've started opening them up, as you pointed out. And I think, as we'll talk about, this quarter, second quarter here, 2021, was when really they gained a lot more confidence about the economy, about the situation with the pandemic, the vaccinations, and they said, okay, well, we feel like we have a little more visibility finally with the economy and where things are going. Let's go make some investments and let's put some capital to work. And in some cases, let's reinstate our dividend, which we had cut or suspended. So that's definitely taking place. And based on the data here, REITs are in a great position to do that. All right. I love this. This is another recent.
One of my favorite little pie charts.
Oh yeah. This is, I could look at this for hours actually, but it's a comparison of the REIT, the sector breakdown of REITs between 2010 and 2020. And what's fascinating is just the changes that you can see. And some of them are not that surprising. I mean, look at what the biggest sector was, Deidre, in 2010.
Yep,
retail. 29%. I can't believe it was that big. Here we are in 2020. It's been cut more than in half. And that might not be surprising. I think what is surprising is just how much it shrunk as a percentage of total market cap. That's incredible, but it's just again, talking about e-commerce and the rise of online retailing over the last decade, especially, that's had a huge impact. But what also stands out to me is just some of the sectors that didn't even exist back in 2010. One of them being data centers. Data centers were out there, of course, but they were kind of tucked in, I think, underneath industrial, or maybe even diversified. I don't even know. But here they are. They're 10% of total market capitalization of REITs. So that's been a big one.
Infrastructure stands out to me too. And, thinking right now about, the infrastructure bill and what's going to happen with that, what we're going to see in the future could be very interesting.
Especially, for in terms of REITs in the telecommunication space, the expansion of broadband, the need for more network infrastructure that fits right into that big slice of the pie. Other things probably less surprising. I mean, offices stayed roughly the same. Self-storage has stayed roughly the same. Residential has stayed mostly the same. Maybe one that is also interesting is just what's happened to lodging resorts. which have also kind of gone the route of retail, which is they've been cut down quite a bit over the last decade or so. That business, maybe it's Airbnb, maybe it's other factors, has just become a lot more competitive, a lot more difficult. If you look at the cap rates, for example, the valuations in the lodging space, so many other sectors of the real estate market have seen compression when it comes to cap rates. And you'd see that normally if interest rates are lower, cash flows are more optimized, that tends to happen, but it certainly hasn't happened on the lodging side. All right. This is another, we love charts here at Million Acres, so apologies, but this is another great one, and just kind of showing who has benefited, what parts of the REIT market have benefited the most, since 2019 Q4, which is, the quarter prior to the pandemic, and then data based on, in this case, the first quarter of 2021. And you can see it's pretty obvious from the chart, the sectors that have benefited most from a funds from operations, from a real estate cash flow perspective, have been, of course, infrastructure, industrial, data centers, self-storage. What's hurt? Well, probably the obvious ones: lodging, resorts, big time, retail, office, healthcare. Also, interestingly, has kind of suffered a little bit during the.
A lot of that senior living and things like that.
Yeah, great point. That's exactly right. What's hurting that the most. And so, so if you knew, well, if you could go back in time, Deidre, and you knew that there was going to be a global pandemic, you could place your chips. Well, you knew where it was going to go, and that's certainly played out over the past year or so. And finally, another look at kind of how REITs have performed, really through and after the pandemic. The sea of red there you see in the middle that really stands out is just I think the acute phase of the pandemic, at least in terms of the stock market. And you can see February 21st, 2020 to March 23rd, 2020, there was not a single sector of the real estate market spared, really. There really wasn't a part of the stock market in general that was spared, for sure. Everything just got hit pretty badly. And then, in the next column over, you had this big rally out of it. But a lot of it, and then you go all the way to the far right, which is interesting, which is, okay, where do things stand today? You can see even the hardest hit sectors, the retail, lodging, healthcare, as we just talked about, they haven't fully bounced back yet. Even though you've seen a 99.6% surge in regional malls, since the bottom, since last fall. But a lot of those sectors just haven't reclaimed their prior footing. And that's also the case if you go down to the office, which is an obvious one, and a little bit of the residential still hasn't quite bounced back. I'll point out, though, this data is as of mid-May. It's been I think June and July were also pretty good for REITs. So it'd be interesting to see when NAREIT comes out with their July monthly numbers, where things stand, because I think a lot of these sectors have bounced back even further. But a kind of an interesting picture of just REITs performance through and after the pandemic. Anything stand out to you, particularly in this table, Deidre?
Well, I think one of the things that we saw was this kind of barbell effect of before reopening, before November last year, data center REITs, infrastructure REITs, and then you had that switch over to the reopening ones,
Yes.
Retail and hospitality. Now we're in this space that's kind of not sorted out yet. So retail and hospitality is still recovering, but still question mark. Some of the office REITs definitely still a little bit of a hesitancy there. And so I think this is just going to be really, really interesting to watch over the next few months, because we just don't know. I mean, but when you think about it, some of this is market sentiment versus what's actually happening. And I think that's an important thing to keep in mind too.
Oh yeah, sure. In the short term, it's almost all market sentiment, pretty much. I like what you said, which is like there is this tug of war between stay-at-home stocks and the recovery stocks and or reopening stocks, and it was you could kind of tell which months were benefiting the stay-at-homes and which months were benefiting the reopening, and now it's a muddled picture. And I think like office is like right in the middle of it. I feel like the office sector is like, you could go either way, right? It's just really, it's so much uncertainty still. All right, well, let's get into some earnings because that's what we really wanted to do today with the hour. And I wanted to start out with NVR, which is a leading home builder, one of my favorite real estate companies actually. And just looking quickly at how they did in the second quarter. Well, revenue up 41%, net profits up 96%, almost doubling. Now, to be fair, that's coming off Q2 2020, which of course was, again, that really acute, I think, COVID quarter where, you had companies like NVR, they were seeing cancellations, they were pulling back on new orders, backlog was declining. It was just really a really uncertain time for so many companies. And so it was just hard to do business in a sense back then, but still very impressive growth off that really tough quarter. Here's one number that really stands out, though, that I saw. The gross margin, NVR's gross margin of 23.8%, highest in almost 15 years. That's incredible. You have to go back to the last housing bubble or strong market back in the 2006-07 period to see the gross margin as high as that. So that's incredible. What's fascinating is, one of the headline numbers for the NVR in the second quarter was that new orders were down 6%. That's the first time I've seen that happen. You follow NVR for a while, you just see new orders keep growing and growing. But in this case, it was a result of just NVR saying, we don't want to push forward really strongly in certain markets because we don't want to commit to new orders given where the pricing was during most of the quarter. But that's okay because they made it up for it in price, because the average sales price of an NVR home was up 20% to $440,000. And that correlates with all the numbers we've been seeing, Deidre, that have come out about the price of new homes from other various sources. So they're seeing it in their own inventory stock, which is just incredible. Go ahead.
Well, I was just going to say, yeah, that is starting to be the new home sales are there's a little more inventory than there is on the existing home sales side. But the other thing, you mentioned that gross margin. One of the things that we're seeing in some of these REITs, and we'll talk more about it later, is the idea that there was something about the pandemic that got companies, they got scared, and I think they got smarter and they trimmed their margins in some ways. And I think NVR is just an example of that, of like being smarter about things.
Yeah. Just kind of knowing how to operate. I mean, and again, the watching how companies pivoted so quickly last year was just a marvel. It's just not something you see now. The actual recession we know now was pretty short. It was short-lived. Yes. I think it went about 2 months, but that still didn't account for so much of the uncertainty that carried through last spring and last summer into the fall. I'm talking before we even knew there was an opportunity to have vaccines available. There was just so much uncertainty. So you can see, like you said, I think NVR and other companies found ways to be more efficient, cut costs when it was smart to do that, but and stay nimble and have the ability to bounce back when things have turned up. And certainly in 2021, things are turning up. Just looking ahead really quick for NVR, backlog up 19% on a unit basis, 35% on a dollar basis. So their business is going to be pretty strong for a while, given those numbers. And then my big question with NVR and pretty much all home builders is, can they meet this demand? Because the demand is huge in so many markets. But can they do that and still protect margins? Deidre, at least in the second quarter, it doesn't seem like NVR is having any trouble with that at all.
Well, I think one of the reasons you've talked about before that you like NVR is their smart moves on the way that they make sure they have land available and using options, which I think is really smart. And the other good news is, lumber went up and then lumber went down. Lumber's creeping back up again, but it's not at that terrible rate that it was, a few months ago. But I think commodities are going to continue to be a concern for home builders. How to have enough product available so they can keep building.
Yeah, no doubt. All right, let's stick with the housing sector for a little bit, and let's go into the single family rental business. Invitation Homes, one of the leading SFR companies in the country, and look at the revenues up 9.3% here. Core FFO really impressive, up 14.4%. Same store net operating income, so that's net operating income, kind of per unit per portfolio house that's been in the portfolio for at least 15 months, stabilized, available to lease, up 8.4%. 80 to 90% of their buying, that's interesting, Deidre, is still one-off transactions. This is Invitation Homes going out there like any other home buyer and, competing to buy homes that come on the market.
Yes and no.
Yeah.
Because I think the thing that they're doing now is they're buying up the iBuyer homes in certain markets in massive quantities. Yes. And so there's this whole new system that has been developed, since the great financial crisis, of these iBuyers kind of recycling these homes into these large institutional portfolios. I find it a really interesting shift to watch.
Yes, and for Invitation Homes, just another avenue for them to buy a home efficiently. They speaking of buying, they acquired nearly 1,600 homes year to date, spending about $570 million. And going into 2021, Dallas Tanner, the CEO, had talked about that they wanted to spend at least $1 billion this year on new home. That it's going to be their biggest acquisition of homes probably since they did the Starwood merger several years ago. So big year of adding homes, and they kind of upped that even more with their recent partnership with Pulte Group to buy 7,500 homes that are actually designed specifically for SFR purposes. So that's an interesting, and I think that's just another thing, Deidre, where another way for them to sort of efficiently expand their portfolio in a way that's smart and fits exactly what they're looking for in certain markets.
Well, and the other thing I find interesting about what they're doing is they're starting to really focus on add-ons, smart home add-ons, air filter add-ons, things like that. So they're not just they've created the system of, renting out homes, but now they're creating all these little ancillary streams of income. They're not a big part of revenue yet, but there's something to keep an eye on, because I think that's really an interesting move and a smart one.
Mm-hmm. And of course, they raised their guidance for the year. They've done that twice now so far this year. And the dividend payout, a lot of people look at Invitation Homes, it's a REIT, and they look at the dividend yield like, wait, less than 2% dividend yield, what? But as if you take the FFO as a percentage of their FFO, it's only 47%. So I think there's lots of room there to grow the dividend. I think the company's just in such growth mode right now. But I wouldn't be surprised if a few years from now we see some pretty healthy step ups in Invitation Homes' dividend. So investors, you might want to get ahead of that. This next slide. So this is a table that you had to go down to like page 36 of Invitation Homes, like supplemental financial information. But I think it's fascinating. And this just tells the story. If you look at, the rental rate growth. So this is renewal leases and new leases that Invitation Homes signed in the second quarter, and the change in the rental amount per, when they did this in each home. And if you look at some of the numbers here, look at Phoenix, Arizona, 23.6% increase in the rent of new leases that they signed. That is huge. 22% growth in Vegas. You can go to their Florida properties and you see some big double-digit gains there. Atlanta of 15.6%. Texas continues to be strong. Even in like the Midwest, you got Chicago and Minneapolis. You've got pretty healthy increases in rents there. So what's extraordinary is that maybe these are coming off COVID a little bit, and so maybe there were some concessions and rents were a little bit lower than they otherwise should be. But these are some tremendous numbers, and it's just speaks to that inflation that we're seeing. It's certainly showing up in rents as well.
Yeah, and there isn't a market where it's really, really cool. If it's a relatively large metro, its rents are up
big time. I mean,
except for with possible exception of San Francisco and New York, but that's sort of a correction of really, really inflated rents. Yeah,
no doubt. All right, so talked about home building, talked about single family market. Let's talk about multifamily. And Mid-America apartment communities, one we've talked about in the past. A lot of strong things going on here, Deidre. Do you want to maybe walk us through this one?
Yeah, starting with that first bullet, I loved that only 151 residents requested rent deferral. They've given rent deferral to thousands of tenants over the course of the pandemic.
Yeah.
By the end of July, they'd collected most of their rents. They talked about it on the earnings call. They're really seeing the storm for them is over. They're not concerned particularly about the eviction moratoriums expiring, having any future impact on them. They think they've seen all of the impact they're going to see.
Yeah, and 151 residents is so small compared to what's been in previous quarters. I was surprised. I don't know if you were, Deidre. I was surprised when I think it was last week when the Biden administration kind of made a strong push to encourage Congress to extend the eviction moratorium. Sorry, losing my head for a second. And yet you saw Mid-America, Avalon Bay, all the other multifamily Invitation Homes, really go up strongly that day. And, it occurred to me, and I put it out on Twitter. And of course, Twitter is just, sometimes the people come out of the work and they can remind you how dumb you are sometimes, and it's great. But, a follower said, well, actually, if you think about it, it's never going to pass Congress. So it doesn't matter what the Biden administration does. I don't think Congress is going to have enough votes to extend it. And I was like, okay, of course, right? So it's not something that the Biden administration can do with an executive order. So therefore, it's unlikely that the CDC eviction moratorium is going to be reinstated or expanded or extended. And so that is good news for multifamily in Mid-America and others. But it's as you pointed out, Mid-America it wasn't really a concern for them even going into the second quarter.
No, it's really the evictions that are taking place are really hitting the smaller, a lot of the mom and pop landlords. And the interesting thing is I agree, we're not going to see the CDC eviction moratorium come back, but I think we are going to see some individual states and counties walk things back just because courts will get overwhelmed. And we've seen that happen already in the pandemic a couple of times. So I wouldn't be surprised to see that happening on a, state and county level.
Yeah, good points. Well, just as we saw with the previous slide on the rent growth for Invitation Homes, like new lease pricing for Mid-America up 17%, renewal pricing up 9%. So your blended average there is 12%. So for the average Mid-America tenant is paying 12% more today than they were going into the second quarter. So that's just tremendous growth there. They're not concerned, as you pointed out. They're not concerned about competitors moving into their area, which is surprising because, as we know, they operate mostly in the Sun Belt markets.
Yep.
And that's where everyone's moving. So how could they not be concerned about competition in those?
Well, they talked about that on the call. And part of the reason that they're not concerned about it is because they feel like, for the most part, because they're the established player in the space, they're getting right of first refusal on a lot of potential acquisitions. So they feel like, because they already have such strong market share in those areas, they were sort of a little dismissive of it on the earnings call.
Interesting. Well, and they've redevelopment is a big thing for them. They're always kind of refreshing and renovating their own portfolio, and they've redeveloped 1,800 units in the second quarter and had an average rental increase of 11%. And they spent about $5,600 to do that, which is a pretty good ROI. With that kind of investment. Always building. They've 8 communities under construction, and this is kind of fascinating. And this last bullet kind of points to the markets they're in, but they're in the markets where 28% of people live, but represent 42% of new household formation. So again, this is where people are going, and this is where Mid-America is and has been for years. All right, I put this chart up. This is not, these aren't Mid-America's markets here, but I thought this was interesting too, because we saw last year, certainly, and in the summer and fall of last year, tremendous concessions in apartments. So, if you were looking to rent an apartment in New York City, Los Angeles, DC, even, just one of those really, historically tight markets, you got some pretty good breaks. You in a lot of ways, you probably got a couple months free rent, or another break on with pricing, and it was just a great time if you were looking to lock in a nice 1 or 2 year lease. But as of this last quarter, at least, those concessions are almost pretty much gone. So, that just speaks to how fast the rental markets bounce back in a lot of markets. And, it's just amazing to see just another evidence of how fleeting, I guess, the worst of the pandemic, the economic effects of the pandemic were for multifamily real estate.
Mm-hmm.
All right. Well, we hit all the residential spots. Let's talk about industrial, which, has never fell off, and it's only seemed to get stronger. Stag Industrial, one of my favorites, and we talk about it all the time. But here you had second quarter core funds from operations, 52 cents, up 10.6% year over year. Same store cash and net operating of 90.9 million. That's up 4.4%. Stag stepped back from their acquisitions for most of 2020. They sort of got back into it in the fourth quarter, but they've really picked up so far this year. And they acquired 9 buildings in the second quarter for 126 million. That's a pretty big quarter for Stag. Stag's a leading industrial company, but they're not a mega company. Right. And as you pointed out, Deidre, it's not just Amazon, which I think still remains their biggest tenant, but they've been also leasing to smaller logistics companies as well. Doubled the size of their acquisition team. That's, they see opportunities in the market. Raised guidance. Stock is at an all-time high. I've followed Stag for years, and no pun intended, but it tends to stagnate for a long time. And seeing it break $40 a few weeks ago for the first time was kind of like, wow, that's quite a move from a relatively sleepy stock like Stag Industrial.
Well, I think a lot of investors want to see this acquisition, want to see it expand because there's so much potential in industrial. I think one of the things that's interesting is that everybody understands industrial right now because of Amazon, because we've been talking about it for a year. That you don't get that thing from people when you talk about it anymore. So I think that's part of what's contributing is that people are looking for great industrial stocks, and that's Stag for sure.
Yeah. I mean, I think if you asked the average investor a couple of years ago, like, hey, have you ever thought about investing in industrial real estate? They would think, why would I want to invest in factories and plants and things like that? Yeah. But no, it's pretty much nowadays, industrial is another word for warehouse, fulfillment, logistics. That's kind of where things are certainly heading. And I'll have to say that, the one thing we'll talk about, we're talking about Stag, we'll talk about East Group in a second, but I do worry a little bit about Stag's approach, because Stag's strategy is very much acquisition driven. Mm-hmm. They like to go in to secondary markets mainly and find where they can buy things off market or negotiate for single assets. They feel like that's an advantage for them. But even in that, I think the cap rates you're seeing for industrial property, they're historic lows. The valuations are extreme. You've got big players like Blackstone, of course, that are in the market. It's got, not to mention Prologis, the longtime competitor. I mean, it's got to be tight, and I just worry. They've made smart acquisitions throughout their history, and I don't doubt they'll continue to do that. It's just going to probably be harder and harder to buy an industrial property for a cap rate of 5.5% and think that you can manage it effectively, and then maybe sell it for a similar or even better valuation in the future. That is going to be something to watch for sure. Contrast Stag with East Group. Now, East Group, another awesome industrial company with a great track record. Their focus is mostly on development. They do some acquisitions, but they're mostly about ground up development. Let's just skip all the other bullets and go right to that bold underline one right there in the middle, which is, I think this is mind blowing.
Yeah.
Rental rates up 31%. Those are the rental rates they're signing for new leases that they signed on their properties in the second quarter. 31%. So if you're a tenant of one of East Group's properties, your rents just went up 31%. Could you imagine being an apartment renter, Deidre, and having your landlord come to you and says, raise your rents 31%, But in a way, the demand is so high, and in certain cases, it's so costly for, a tenant to move that they've got to stick around. And in a lot of ways, these rates are kind of catching up, because you have to remember, tenants sign leases for 5-10 year time frames. So some of this is catching up, right? The market has certainly gone higher, and East Group is catching up with a lot of tenants. And tenants kind of knew this was coming. But my gosh, that's still a mind-blowing number, 31%. And to go along with, great funds from operations growth, average occupancy almost 97%. They've been adding properties either through new development or, properties they've been doing value add on. 166 consecutive quarterly cash dividend. That's impressive. It's almost getting into that dividend aristocrat zone, but I think you also have to raise your dividend every year to be in that. I don't know. But what's interesting here too is a lot of people look at East Group and say, "Oh, dividend yield, low, kind of low compared to Stag and others. Why is that?" Well, again, development's a big reason. Focus on growth, but if you look at their dividend payout ratio, just 54%, whereas I imagine someone for like Stag, it's probably up in the 70% range. So definitely room to increase the dividend in the near term for East Group, and we'll see if they do that. They did last year. We'll see if they do it maybe before the end of this year. All right, let's shift over to the most muddled picture, I think, of the real estate market, which is office. But we'll start with one that's not
so office.
Not so office, more like a life sciences R&D, whatever, however you want to classify it. But it's in the office sector, so we'll treat it as an office. But Alexandria Real Estate Equities, really strong leader in, again, life sciences R&D office. But they didn't, again, one of those companies that didn't skip a beat really in 2020. In fact, they're probably seeing, given so many things that have happened with the pandemic, including the need for more lab space, they're benefiting big time from that. In fact, they think the fundamental drivers of demand for their real estate is the strongest they've ever seen. And they had the highest quarterly leasing in the 27 years of the company. That's amazing. I mean, just in this quarter.
Well, there's so much demand. They talked on the earnings call about the number of startups in the biotech space, the amount of venture capital flooding to that space. All of that is good news for them. They've got Pfizer, Moderna, and Johnson & Johnson as tenants, and that's just they've got 750 tenants, so they've just got so much demand coming at them right now.
Yeah, and you mentioned the tenants. I mean, I think over 50% of their tenants are either large publicly traded corporations or credit tenants. That's a great tenant roster to have. No worries about collections, as you can see right there. Here's the one bullet, of course, that makes me worried, right? When I look at their acquisitions in the quarter, $580 million at cap rates in the 4 to 4.2% range. Wow, there's two ways to look at that. Either that's really expensive, or they're buying properties where there's lower occupancy. So the net operating income might be compressed at the moment, which is another reason why cap rates can be low. But assuming those are mostly stabilized properties, those are hefty prices to pay. Now, if you're a company like Alexandria, you can borrow money cheaply. You have great credit. You have no problems with ever accessing or tapping the capital markets. You can probably make those cap rates work, especially if you think the rental yields on those properties are lower, and you're going to boost those up and drive higher NOI. But just like we saw with Stag, the one thing I worry about is you have some very aggressive companies that are seeing opportunities in the market, but man, they're probably paying a hefty price for some of their opportunities.
Well, yeah, and part of that is their cluster strategy. So they're buying in expensive markets. They're buying in Boston. They're buying in San Francisco. They're buying in Raleigh-Durham, which has gotten really expensive because of the attention that's kind of gone there. So that I think is part of it as well. And that's part of the not the problem of life sciences, but a concern is that you are limited to certain markets because of the strategy.
Yeah. And they know those markets, as you point out. This is where they already own property in a lot of cases. And they know they've been following a lot of these buildings for years, decades probably, and understand, where there's opportunity better than most. You pointed out that they have a big focus on ESG, which I think is great. I mean, they are certainly, if you look at a lot of their buildings and developments, I mean, these are high-end Class A office buildings that are sort of state of the art when it comes to
beautiful buildings,
energy efficiency technologies. And so in a way, you might look at that and say, well, that, what's the ROI on doing that, right? Well, the ROI is you tend to attract a lot of high-end tenants who want to be in buildings, who want to, work in those buildings because of that
and who need to satisfy those demands from their shareholders as well if they're publicly traded. Is so that's a good look for them. There's that growing awareness of ESG across real estate right now that I think companies that are getting ahead of it are smart. Stag is one of them that's been doing a lot with solar power. So,
Yep.
It is a smart move for the long term, in my opinion.
Absolutely. All right, here's one, Deidre, that I know a little bit less about. Boston Properties. Maybe you can walk us through their earnings.
Yeah, I mean, not a great quarter for them. They're dealing with losses. They're heavily clustered in some of the similar areas of Alexandria, but they don't have that much in life sciences. They've got less than 6% now. They're trying to play catch up. They've got 3 new lab developments. One of them is in Montgomery County. One is in Greater Boston in Waltham. They're trying to, they're trying to pick up speed, but it's not great for them, because they're got a lot of traditional office. They talked about the San Francisco market being behind the New York City market and the Boston market in terms of office reopenings in general, and they've got a lot of presence in San Francisco, so that's been hurting them in general. They're moving toward life sciences. They're doing a lot of interesting things, but they're still suffering a lot of losses, and it's any continued delay in people going back to the office and companies starting to make those decisions long term, I think is going to hurt them. They don't have a lot of leases coming due over the next couple of years. It's one of the things they talked about on the call, but enough that it is a little bit of a concern. So they're sort of betting that the companies, the offices that have 5 years more or 7 years more, we're going to be in a different world by then. But we may not be in a different world a year or two from now.
Yeah, this is such a contrast with Alexandria, right? This is sort of your traditional office in traditional markets, like like you said, your New Yorks and San Franciscos of the world, and certainly haven't bounced back. And then what's also a big bummer is that I think before this Delta variant sort of sprung up, unfortunately, I think you had a lot of big corporations who were kind of looking to get their workers back to the office probably by the fall for the most part, even the end of summer. And I think a lot of those plans have been pushed off a little bit and even rethought. And so that's just has got to be hurting Boston Properties for sure. And I think I like what you have on the next slide, which is kind of just their breakdown. This is like, in my mind, this is exactly how probably most traditional office tenant rosters look. Like, the breakdown here, right? It's pretty diversified across a lot of different sectors, but where they want to probably be more of is in the life sciences area, where they're, they have a 6% presence, but or even technology a little bit. They probably wanted to be more in those areas, but
even manufacturing, anything where people actually have to be in the building. You can kind of look at this little chart and think, and sort of go through it and think like, okay, how many people in that sector need to be in the office, and kind of figure it out that way. And when you start looking at it through that lens, it gets a little scary.
Yeah, it does, because you got your legal services, your heavy financial services, and those are a lot of places where, most firms can probably work pretty effectively at home or even more distributed than a collective office. So tough going right there right now for Boston Properties. All right, tough going, but not really. Retail, right? Simon Property Group. Pretty darn impressive quarter, I have to say. I didn't get to look into it too in depthly. I think you probably looked at it more than I did, Deidre, but this is, I mean, man, if you wanted to bottom fish a year ago, this was probably the scariest one you would have looked at. You said, wow, if malls are already dead and this is going to be like the final nail in the coffin, right? But in fact, Simon Property Group has bounced back really tremendously. In fact, they're increasing their guidance, even raised their dividend. What is going on here?
Well, I mean, Frankel's been saying this all along throughout the pandemic that, that Simon was, if you were going to bet on retail, Simon was the one you should bet on because, rock solid balance sheet, nothing to worry about there. Even the things that they've done that I've been a little bit, cast a side eye at, betting in on Aeropostale, Brooks Brothers, Eddie Bauer, JCPenney, that's kind of paid off for them, which is fascinating. And, the Simon Property Group it's always a good earnings call. David Simon is so, so proud of his company. He gets a little feisty with the analysts, which I'm not mad about. But he was very, very clear about physical retail is not going anywhere. They're continuing to grow. They're seeing lots of activity, lots of demand for their leases. I mean, we've got here signed 2,500 leases year to date. They're really seeing demand from stores, from restaurants. They're seeing strong foot traffic. He's pretty darn happy with where they're at right now.
Yeah, I mean, and they seem very confident. I mean, and I was looking at you can still get a nice dividend of a yield of about 4.7%, I think, right now, which is, say what you will about retail, but I'm sure, this is one of the smartest, if not the smartest retail company probably in the country. And so I think David and Simon team know how to manage it, and will probably manage it effectively for shareholders. So kind of wish I just dove in when things were terrible last year.
Well, the interesting thing is too, just talking a little second about watching some of the retail numbers this year, watching some of the earnings from companies like Skechers and Nike and things like that.
Yeah,
retail's been pretty good this quarter. Not everybody's a winner, but a lot of things have been pretty strong, and all of that I think is good news for Simon too, because these companies are seeing. I think they've done enough of the store closure that they're going to do. And now they're starting to think they're like getting smarter about where they reallocate. And some of that could be good news for Simon, because Simon does operate the malls. If you're going to go to the best mall, Simon usually is the best mall.
Yeah, no doubt. All right. I think this is our last one. Hospitality, Ryman Hospitality Properties. Hey, speaking of bouncing back, right? This is one that's bouncing back.
Yeah, on the call they talked. Colin Reed, their CEO, talked a lot about. They ended up talking a lot about July, which not part of the quarter, but just the strength that they're seeing right now. They've been seeing a lot of rebookings. Rebooked 1.9 million so far this year. That's a lot of nights. 66% of those lost. But what's interesting is that the new organic bookings are now outpacing the rebookings. That just started to happen for them. So they see that as a real positive. Colin said that he feels like they're going to come out much stronger than they went in. He talked a lot about loyalty and return visits, that they actually have more of a loyalty-based strategy versus a product-based strategy. They don't have a ton of hotels. There are a few Ryman properties, but they're all these really great resorts that people want to come back to with their companies, with their families, time and time again. And that's some of the long-term value there.
Yeah, final month of the second quarter, they also generated 28 million in operating cash flow. So they finished the second quarter strong, and you mentioned July is looking great for them. Great to see the Gaylord National back open. That's just across the river from where you live,
yes.
I think. And so,
yep, I can see it from here.
Right.
And and the smart thing was that they did a massive room renovation while they were closed, which is I thought that was really smart. And it's done on time, on budget. I want to go check it out myself. But the other thing I found was really interesting is that they're booking concerts. So that's part of the thing with Ryman. They've got the Grand Ole Opry, they've got Ryman Auditorium. They're seeing massive demand for entertainment. And, thinking about this, hopefully the Delta variant won't mess this up. Everyone seemed to be out in Chicago at Lollapalooza over the weekend. There's a strong demand for entertainment, for seeing concerts. It's one of the things people missed most during the pandemic. And I think that's part of what has been fueling interest in Ryman as well.
Mm-hmm. Yeah, one of the companies that I tend to follow as well is Live Nation, and you kind of see this. They own some incredibly great venues, and obviously they're hoping for that too. And they were seeing a lot of that, and then of course now it's just, again, as we talked about, the Delta variant. How bad is it going to be? How bad is the fall going to be? It seems like we're heading in the really right direction, and hopefully we still are. But that is certainly thrown a little bit of a curveball into the mix.
Well, I just want to mention one more thing about Ryman. The quote from Colin Reed about margins, and he said that we'll run at improved margins when we're through this. And so, similar thinking about that I've heard from other companies too is that it really did change how companies allocated resources. Realogy, Ryan Schneider, the CEO there, talked about that on their earnings call, that there's just that some of the lessons of the pandemic are actually going to, help them in the long term.
Mm. All right. So there you have it. We hit a bunch of earnings results, but
Can't believe we got through it all.
I know, but there are more to come in the days and weeks ahead.
Yeah. Thursday's the day that I'm looking most forward to. I mean, look at that, August 5th. That is a great day to check out some earnings.
Big time. I mean, Boston Omaha. I mean, did you saw the news, I'm sure, with their SPAC deal for
yes,
Sky Harbor?
Yeah, I know. Matt Frankel is doing a deep dive on that for you for Real Estate Winners, which should be very interesting. I think that's, I don't know much about about Sky Harbor, so I'm really intrigued.
Yeah, well, the fascinating, I don't know much either. I've just what I've looked at in the last few days, but just strategically, if you think about rich people or corporations flying privately to strategic locations or resort locations throughout the country, they seem to have some pretty good spots. And I have to say, like, that is that's got to be a growth business, especially post-COVID. If you think about it, just the idea of flying privately to a private hangar, airports, being able to, again, if you're a very wealthy person, store your plane there and fly in and out without, and avoid the airplanes or the massive airports and all the stress that can come along with that, and the commercial airliners. So anyway, I think that's a great addition to Boston Omaha's portfolio there. We'll just have to see how it plays out. But MGM Growth Properties is another one I'm looking forward to this week, just to, again, kind of in that Ryman flavor, see how their business is bouncing back, what's going on there. A couple spot, Open Door is, wow, what a struggle, right? Yeah. They report next week, and again, we think of them as the most direct way to bet on the iBuying phenomenon. But the market has not been kind to their stock, and I think this is going to be their first full quarter of earnings since going public. So I'm very interested to see what they have to say about how the business is going. And
do you think some of that negativity is just the thing that seems to happen sometimes during the first year?
No, I agree. I mean, you're even seeing that with Airbnb is another one on there, right? You're seeing that. Right. I think Airbnb is trading below where they came public at a much lower price, but where they debuted was, I think, higher than where the stock is trading today. And so it can happen. I think there's just a lot of, there tends to be a lot of skepticism early on with newly public companies. David Gardner told me something a long time ago that I always forget, which is he's always paying attention to new public companies and rule breakers, or he was in the past. And he usually liked to wait until a company was public for at least a year. And if you look back a year after a company debuted and they were beating the market since that first trading day, that they were public, that's usually a really good sign. So it's almost like if you're interested in Airbnb and Open Door, or any other new public companies, Matterport's one that just had their SPAC, right? Almost wait a year. You might miss out on some returns, but you'll sort of get validation by the market as to whether these businesses are going to succeed. And I thought that was always a fascinating way to approach it. And no one's going to doubt David Gardner's track record when it comes to picking new companies, right? So there you go.
But I think there's that eagerness. A lot of people want to, it's like, oh, it's new and exciting, but there's a lot of prudence in waiting.
Absolutely. And then, one company that always reports so late out of the cycle, and it's always forgotten, but it's Vail Resorts, because they're a little bit of an off schedule. But what's amazing about Vail Resorts is I think they recently hit a new all-time high. If you think about a company that their timing was just right, and their business was just right for a pandemic. No business is right for pandemic, but right. Especially in the resort business. But their ski season was almost wrapping up when the pandemic really hit in 2020. And then we got to a point in the following fall where things were struggling. Their bookings were down and their ticket sales were lower. But skiing became almost an escape for a lot of people, right? So it's a lot easier to go rent a condo or a ski lodge and go skiing with your family, and which tends to be a more inclusive event, than some other vacation options, right? So their business has really skied through this, to use a terrible pun, and I think you're going to get validation of that when they report their ticket sales and bookings next month.
Well, one of the things that's interesting with them too is the impact of remote work has been good for them because you get and remote schooling. People thought, well, if my kids are just at home doing Zoom, they can do Zoom, anywhere. And who knows what's going to happen with the Delta variant this fall in terms of schools. Some schools have already started. We've seen some reports of cases. It's going to be interesting to watch what happens there and then how that impacts entertainment, hospitality, office, all of that. One of the reasons I love studying real estate is just because it's all human behavior and it all connects together. And when one thing changes, everything else changes.
Right. Yep. All right. Well, I will stop sharing. That was a lot of earnings, Deidre. My head's spinning a little bit. But
it was. We've got a couple of people asking for the slides.
Oh, yeah. Sure. I wouldn't. I guess maybe they can send someone a direct message. Maybe you. You can send the slides. But happy to share the slides for sure.
Yeah, we'll definitely figure out how to get the slides to you. We've also got a question on examples of infrastructure REITs.
Oh. Well, yeah, for the most part, infrastructure REITs these days is your American Tower, Crown Castle,
right?
SBA Communications. There's one more company that's always escapes me, but it is pretty much dominated by by your cell towers. That's kind of it. Infrastructure is almost their sector for the most part. They could almost call it telecommunications or networking, but it's the infrastructure. So.
I've got another question about NVR. KD wants to know why the demand was down for them. I'm guessing it was a pricing thing, but do you have any more info on that?
I don't. One thing about NVR is interesting is they don't do conference calls.
Nope.
So you don't. All you get is just this really one-page press release every quarter, and that's it. And of course, you get the annual report at the end of the year. They don't reveal much. I would have to. I think you're right, Deidre. I think it came down to pricing. Just people got a lot of cold feet. It could also be NVR doing that as well. And they just decided to not market as much in certain markets where they wanted to see how pricing worked out. So it could be a combination of price sticker shock, but also NVR's own sticker shock when it comes to input pricing. So
yeah, definitely.